Hi, Paul Gerard from Price Accounting Services, back talking about trusts, and particularly in this one we're going to talk about what's called a hybrid trust in our series on structures. Okay, hybrid trust, wow, this is a complex one, and this is going to be short, okay? Hybrid trusts can be a very effective vehicle in some situations. However, I need to warn you that in the 1990s through to the early 2000s, there were a number of tax cases concerning misuse of hybrid trusts in tax schemes, okay? Now, this is not to suggest that hybrid trusts are a feature of tax schemes. They used to be, but commonly would not now. Sometimes, let me explain what a feature of a hybrid trust is, which is different to that of a discretionary unit trust. A hybrid trust is one which has features similar to maybe a unit trust, but also discretionary features. So it might combine both fixed and non-fixed rights to income or asset entitlement. So this can create some good benefits in some situations, and in others it can be disastrous. The ATO has got tax rulings on hybrid trusts which confirm more than refute that hybrid trusts can be used, but they've got to be used for good, not evil, okay? So it's really important you get really strong tax advice from somebody who knows hybrid trusts well. Myself, I know hybrid trusts fairly well, having worked for a company that produced and sold hybrid trust products. I'm familiar with the tax rulings. I'm also familiar with the positive and negative implications of using a hybrid trust. A hybrid trust can take generally two forms. A hybrid unit type trust is one which might offer fixed units or might offer units in the trust, but offer more than one class of units. Good example of that being used for good, not evil, may be a property development. A property development where one party is to receive a preferential entitlement and right to income. For example, the financer might have called for the first 20%. And so they get the first 20%. Then the other unit holders get the balance. Or it might be a fixed amount where it calls for the first $100,000 goes to that unit holder. Then the other unit holders get the balance in a fixed proportion. So there are ways to make a hybrid trust work, and it can be useful, but it definitely needs legal advice and definitely needs sound tax advice. The other form of hybrid trust, of course, is a hybrid discretionary trust. So the common feature to a hybrid discretionary trust is it will have a discretionary capacity and also a fixed right. So for example, and again, this is where a hybrid discretionary trust might be useful in a property development. So Party A has contributed funding and expects to get $100,000 worth of income in return as a form of interest, for example, or equity stake. They may have a fixed entitlement through the issue of units in that trust, and following them being paid that $100,000, those units are redeemed, and then the discretionary elements follow, just like a discretionary trust to, for example, mum and dad. So that can also be addressed. But it's important that it's done carefully and properly, and it's under correct tax and legal supervision to make sure that you're not falling foul of the tax office, because they do have some rulings which pose a concern to some behaviours with these trusts. And so I hope that's helped explain what a hybrid trust is, degree of caution there, and I hope if you've got any inquiries about a use of a hybrid trust, we do welcome it, but we do exercise a degree of caution that we only discuss with people who are really intending to use it in the correct manner. We don't support or assist clients who are intending to any mischief, so that's a warning there. And so we hope you continue to follow this series and watch some of other short videos where we talk about some other structures, and we're going to just talk in the next video about some general forms of other trusts, and so we look forward to seeing you then. Cheers.